Hello and welcome to the Property Trio. And have we got a wonderful episode in store for you all today? We are talking all things apartments. But before we jump into that, I'd like to welcome my wonderful two co-hosts, Mike Mortlock and Cate Bakos. How are you today, Mike?
I'm doing well, Dave. I'm jazzed up because I get to share some data in this one. So I was excited. I could barely sleep.
I love it when you're jazzed up, Mike. Really comes through the screen. And Cate, how are you? This is your making, this episode. So
I'm excited about this one, and I'm also excited that we're not talking about our weekends.
Yeah, we'll just jump straight into it for our listeners, but go Pies. So, Cate, let's start with defining apartments. There are so many different types of apartments, from high-rise to low-rise to boutique, low density. How about you talk us through, and our listeners, where you typically find these various types?
Yeah, great question. So apartments are one subset of unit markets. And of course, we've tackled this before, townhouses, villa units, they're all in the subset. But apartments, they're a strata subdivision, and there's lots of different types of apartments, as you've just outlined. So high rise, high density, they tend to be in the city areas, and they're often on main roads. And your lower density apartments and your 2-story, 3-story, they're usually older apartments. They're pre-lived, so you might find them dating back to Art Deco era, or they could be 60s, 70s, 80s apartments, and they're generally well located. So they're all having a one size fits all opinion of apartments is the wrong thing to do. And of course,
isn't it?
Yeah, and we have different appetites for apartments in different cities as well. So in Melbourne, for example, as we'll talk about in this show, they've underperformed quite badly over the last 10 years, but in other cities like Sydney, that hasn't been the case. So we want to delve into it and not just have a stigmatised view towards apartments, because there are some ripper apartments out there. So while I'm talking about that point, what would your favourite types of apartments be, Dave, and why?
Well, look, that's a great question, Cate. It really cuts to the chase of where you've started, which is differentiating different types of units from the rest. And so, I'd talk about a really specific type of apartment. So if I was going to be picking, the ideal apartment to purchase, would be one built primarily in the blocks built in the early 1900s and up to the pre-1970s era. They're double brick. They're often, as you've touched on there, they're showcasing Art Deco or brick clinker style. The location's got to be prime for me, so nestled in and in a suburb. They're tucked away in a quiet back street. Not all of them are, but the ones that I would be buying would be. And just to give you an idea of the underlying land value, the surrounding houses are often priced in the millions. So, for me, I'd be buying in a block that is 2 stories and consists of around 6 to 10 apartments. One of the things that's unique with the positioning of these older style apartments is they're built closer to the centre of the land, whereas today the medium high density apartments, they're built right to the perimeter. If you step outside, there's a vast expanse of well-maintained lawn and garden, dotted with beautiful old trees for the tenants and their guests to enjoy. A bonus is they come with a car park on title. And when it comes to space, these older style units have larger rooms and high ceilings. So the question of why these properties so cherished, the scarcity makes them more highly sought after. Beyond that, there's the architectural allure and the high land to asset ratio, which we'll talk about later on, and of course that unbeatable location. So, that they're the ones I love, really. So that's sort of the answer to that question. Now, apartments, they're generally not as favoured by investors seeking capital growth as houses are. And just quickly backing this up, CoreLogic did a study in August 22 of the last 30 years of housing data, and in the combined capitals, houses rose on average, let's remember, 453%, whereas units were 307%. And in regional areas, houses were 314%, units 213%. So, Cate, that's about a 100% differential over 30 years. Can you shed some light on why you think apartments have broadly outperformed houses over that period of time?
Yeah, they've underperformed houses for that very reason. Australians do chase that great Australian dream. We like
Mm.
having the hills hoist in the backyard. But investors have really been cognizant of the fact that in certain cities, apartments have really badly underperformed. And in
Yeah.
some cases, they haven't performed. I mean, we
Yeah.
had a real flat line in Melbourne. And I would
Mm.
put that down to an abundance of new apartments. We had cranes on the horizon for that entire 10-year period. And as a result, the good quality, lower density apartments kind of languished. And
And that's only really started in the last 10 years,
yeah,
hasn't it?
it
Yeah.
is. Because I remember becoming a buyer's agent in 2010. And at that time, a lot of the experienced buyer's agencies were targeting apartments for investors. There was this mindset that you can't go north or west, God forbid. You've got to stick to the leafy east. And if you haven't got
Mm.
enough money for a house, you should buy an apartment. And, in
Mm.
hindsight, it wasn't a great idea and it wasn't very imaginative because there are good performers outside of the leafy east. But
Yeah.
I think that the fact that aligned with an explosion of new builds and very high density builds. I mean, we had Docklands was a brand new
Yeah.
suburb, and we had towers everywhere. If you think about
We are
South,
showing our age, aren't we, when we remember
we
that
are.
was when that was new.
Yeah, when Docklands was new, and we consider South Yarra and Armidale, and some of those really trendy inner southeast hotspots. They had lots of towers on the horizon as well. So we had an
Yeah.
overabundance, just a total oversupply.
Mm.
And the bigger issue that that we were facing, people were really liking the glossy and the new, and the developers were throwing opportunities at them, and we had incentives, government incentives to buy brand new. So yeah, the older apartments certainly did take a hit during that
Yeah.
time.
It'll be really interesting to see if they catch up again, the older apartments, because if you do the individual property reviews, which we've certainly done, you find they were on par with houses until about 10 years ago. But it's really the gaps happened in the last decade with the
Yeah,
older
very much
apartments.
so.
Mm.
Yeah, and I'm seeing, I don't want to call it too early, but I'm seeing a little bit of a renaissance for the older style apartments. And we're also
Yeah.
seeing a lot of downsizers or right sizers who are targeting really good quality, larger inner city apartments. So for the amenity and the space and
Yeah.
no stairs, there's a lot of appeal there. And we've got an aging group of baby boomers who, if they're even just a percentage of them are targeting this kind of change, we could see apartments play catch up.
Yeah, it's going to be interesting to watch that space. But it's
Touched on.
probably
Sorry,
time to
Dave.
bring Mike into the
Yeah, we
podcast.
should bring you into it. Dave and I just having a
Yeah.
chat.
I'm still on this show. Aren't I?
Yeah.
What about me?
Yeah.
I just want to pick up on a point you made, Cate, where you were talking about some established buyers agents that are saying, buy in this suburb, a house. If you can't afford it, then buy a unit, because they were so blue chip focused, right? That
Yeah.
seems to be like a constraint of that philosophy. If you are blue chip in, let's say, Melbourne or Sydney, houses are kind of off limits for all but the sophisticated or hyper wealthy individuals. So when you've got that sort of robust philosophy that it's blue chip or bust, putting someone into an apartment, the fundamentals completely change. It sort of begs the question, well, there are regions that have blue chip aspects, right? Like,
Yes.
so I wonder, like, is it just sort of their model doesn't have the flexibility to do that because we only buy in this area and we're buying there forever? Was there sort of a little bit of a lack of creativity, you think?
Yeah,
Look,
very
yeah.
much so. I think so. But Mike, to that point, if we use Sydney as a really good contrast, there's a saying that I often use when I'm talking to investors: you want to buy where there's really strong owner-occupier appeal, because it's the owner-occupiers that will bid emotionally and drive prices up. So whenever agents talk about, oh, this would be great stock for an investor, I think it's probably terrible stock for an investor, because if it's so bad that an owner occupier doesn't want it, then an investor should not be targeting it. But if we think about Sydney, for that reason that you just stated, most people can't afford a house in Sydney, so they will target apartments, and that's a way of life and something that's completely accepted in Sydney. So their apartments have performed a lot better because the uptake has been a lot stronger, and price preclusion for houses is probably the key reason there. But they've also got gorgeous apartment blocks dotted around the harbour with amazing vistas. So, it's quite a different market to us.
And I think, like we were one of those businesses, to be honest. Our buyers agents we were one of the early buyers advocacy businesses. A number of our buyers agents came from one of the first buyers advocacy businesses in the inner east of Melbourne. And the data did reflect, until about 10 years ago, those older style apartments had kept pace with houses as well. So, the numbers have changed over the last decade. But then there certainly, I think, is a proclivity, and I don't think this is why we like to refer to buyers agents who are specialists in their area, because people do tend to stick to the areas they know and live, particularly in big cities, because it's just logistically difficult to cover the whole territory of Melbourne, for example. So, there are different factors at play that have driven some of those, I guess, choices over time. And I know some of our buyers agents, we definitely purchased older style apartments for a number of our clients. And unfortunately, they've underperformed certainly in the last 7 to 10 years.
Yeah.
So, Mike, your business has conducted the 1,000 asset study, and you do have some interesting data about apartment buyers. Can you shed light on how investor appetites have varied over the years of collating that data?
Thanks, Dave. I'm so glad you asked. I think it's interesting. And people like Cate think it's interesting. So at a sample size of 1, that's 100% success. So on that basis, I'm happy to share it with everybody.
Well, you can add me to that sample size. I think it's interesting too.
If we go, so the 1,000 asset study is a look at 1,000 residential property purchases by investors, normally in an each financial year basis. We haven't released our 2023 data as yet. Begs the question, when will we? When it's October. But I have crunched some data specifically for you today. If we cast our minds back to 2016, 2017, we found that 47% of people were actually purchasing units, which is a pretty high amount, because once you sort of go over to 2018, 2019, it sort of drops down to 40. And really since then, there's been a huge drop off. So in the financial year that's just gone, it's only 18%. And the year before that was 22%. So units,
really?
We really saw units go out of favour. I sort of put it down to a few critical events that all sort of happened roughly at the same time. I mean, there was obviously the pandemic, and units basically got smashed. Yeah. Because of all of the students that kind of weren't around anymore to rent these properties. And we saw huge vacancy rates, double digits, which seems crazy to talk about today when we're, trying hard to get 1.5% in a lot of places. But if you remember, there was the people in Sydney that were evicted on essentially Christmas Eve, I think it was, with building defects. There was a number of stories around unit defects, and there was also cladding issues. And so units really got a bad rap. And I think investor education has certainly evolved to the point where people are starting to realise that typically units will underperform. We probably saw a huge amount of purchases from overseas investors, many of them from countries that covet the apartments. So when that sort of drops off, then we see a change in those numbers. But, units have become a little bit less popular. One thing that we've been tracking as well is the number of units that actually are within a development. So when we looked at that in 2017, the average number of units in a development was 61. You contrast that to the last 2 years, 21-22 was 116 and 22-23 is 110. So unit complexes
Almost
seem to
doubled.
be getting bigger. So investors are buying in these bigger complexes. And Cate mentioned gloss before. I always kind of think it's funny because people pick on gloss because gloss is normally only used for evil. It's used to make something appear shiny when it actually isn't. And within those glossy brochures, they will talk about things like depreciation. And when depreciation is used as a selling tool, I would recommend, even though I've made a career on tax depreciation and I love depreciation, I would recommend you put up a little bit of a red flag.
Yeah.
Yeah.
And do you think also, obviously a lot of apartments that are bought are new and we're obviously building less. So do you think that's played into the reduced numbers as well?
Yeah, I think so. Like certainly in the last little while, and the deductions, it's. I think the price point and the deductions. There's some interesting data that we've seen as well. So, for example, the total deductions in the last financial year for a house were averaging 188,000, whereas a unit it's 272,000. So there's a big difference from a deductibility point of view, and I think that a lot of people disproportionately fear tax over sort of looking at capital growth upside. It's that carrot and the stick sort of stuff. Certain people are very stick motivated, and tax is a stick to a lot of people.
And look, a lot of people get advice from their accountants, and having dealt with a lot of accountants over the time, it's one thing that's always sort of stuck with me is you have clients come to you and my accountant has suggested this property and it's a new property because it does make the tax deductions look much better from the accountant's perspective.
It drives me mad. I've said to an accountant once, your job is to help them grow wealth, not to save them tax.
Yeah.
The trouble is that often we go in with preconceived ideas. It's a bit like going to the doctor going, I think I have typhoid. And they're like, well, that was extinct in the 1920s. You definitely don't have typhoid. I don't know if typhoid's extinct. I haven't researched this, but people go in with these preconceived notions.
The name we give diseases that have been eradicated.
Extinct disease.
But people will certainly go to their accountant to say, and they'll say things like, I need to buy an investment property. And the accountant will say, oh, okay, why is that? And they say, because I'm paying too much tax. And it just begs the question, like, do they care about the performance of the asset or is it just really designed about, minimizing their tax? When it comes to the difference between a house and a unit, the first year deductions in the last financial year were averaging about $10,500 as opposed to $7,500 for houses. Now, in your pocket, that's maybe a $1,500 difference a year. It's not a huge difference, right? But we know that the historical performance of units compared to houses is, I mean, it's the gap has shrunk a little bit in the last little while, and I think the reason for that is because unit values got smashed during the pandemic for a period. So we're just kind of catching up a little bit. But as you say, in 30 years of data, units have underperformed. And when I think about units, I think about the typical high-rise apartment with 110 units in the complex. So not all units are created equal, right? But on the whole, they underperform. I've got one more for you, Dave.
Keep going, please.
If you'll allow it. One thing that I saw in the data
what's one more going to hurt?
One last thing I found in the data, which was interesting, that in the last financial year, the average purchase price for units was $771,000, whereas houses was only $691,000. So that kind of pulls into question, like, do people buy units rather than houses because they can't afford to buy houses? Well, in this sample, which we're talking, this is not just 1,000, it's thousands and thousands of transactions that we actually looked at in this last set. It didn't bear out. So that's something that I didn't expect to see as well.
No, that is unusual.
Yeah. Another thing too, with apartments is you tend to get the higher rental return as a percentage of the purchase price value. And
Yes.
obviously, that's, as we know, that's a bit like the moth to the flame. It's the easiest thing to measure. It's a real number today, but the hardest thing to measure or understand and ascertain is the likely growth in value of the property and also the growth in rent. And that's where it also can attract people to what turns out to be a poorer investment over the long run.
Look, I was going to say, with rising interest rates and loosening of credit for investors, I'm not shocked that apartments have come back up a little bit and that the disparity between units and houses has closed a little bit more, because people will look at cash flow when they're borrowing with a higher interest rate. So I have a lot of people saying, I'd like capital growth, but this is my constraint. You know, the out of pockets that I can afford each month, or the amount that I can contribute to my investment account to keep this property humming is X. And if it is prohibitive for them to have a house based on their financial capacity, then unit it is.
Yeah. Cate, with Mike's data, and it's covered on we've actually covered off a fair few different points there.
I got stuck in.
But yeah,
He's catching up.
Yeah.
Having
He was at
his
the crease.
say.
He was at the crease for a while.
It's all right.
So,
I'll see you later, guys.
marking out centre. Is some of that consistent with what you've found over time? Yeah.
Very much so. I had a few points in mind to share in relation to what Mike was saying. People did wise up, partly because buildings were in the news, and also because we heard a lot of stories about off the plan, particularly, and people getting caught out. So off the plan purchasing, some will argue that there's huge upside because you can put down a teeny tiny deposit and make a mozza of money if capital growth goes your way between signing the contract and the sunset, when either when the property is built or when it's time to reconcile the value of what you've invested in. But the problem that we saw throughout this period in a lot of different capital cities and regions is people would sign up to purchase something at a particular price, and the prices would go sideways or down.
Yep.
So if it comes time to settle and you're what we call underwater, it means that your asset is worth less than what you paid for it. You'll have a hard time covering that with a loan. And a valuation shortfall is everyone's fear. But if you haven't got the capacity to cover the shortfall, you lose your deposit and you can be sued. So when it comes to off the plan, even if you've just put down $1,000, they can go after you. And developers did. So there were a lot of doom and gloom stories out there about that. But there are more reasons why people have avoided some of these apartments as well. And they're important reasons. The next one is that banks don't like properties that are under 50 square metres of internal space. You will be able to find a lender who might tolerate it. Some lenders will have a threshold at 45, some at 40. But generally speaking, if you're having to scramble around to find a lender because you've chosen a dud asset, it's not a good look, and it doesn't bode well for your resale prospects with that asset. So what we do know is developers have packed more into the buildings, they've gone higher and they've gone smaller. So when you're
it's all about profit.
It is, but if you're getting these
the more properties
little...
you put on as little a parcel of land as possible, the more money you can make as a developer.
I think so, but developers are getting a bit smarter now, because these teeny tiny one betters, no good if you're looking at a traditional local loan. And we had a lot of offshore purchasers paying cash for these horrible little units, but that didn't save the day for the developers. So we're seeing some more clever and generous floor plans these days. But while I'm having...
Which is great to see.
Yeah.
And it should be encouraged. And that's the sort of thing, the government should be influencing the councils on to free up the development of.
I think it's we've been tracking the floor areas of houses versus units for forever, and units on average are sitting around about 80 square metres, which is almost exactly half the size of an average house that an investor purchases. And I don't think it's it's anything other than developers realizing that old shoebox model doesn't sell anymore. There's a period of time, perhaps in that Docklands Renaissance, where all this stuff was built, where the one bedroom stuff was flying off the shelves. But these days, developers are realizing that there's whole boutique markets around downsizes that will actually pay a premium for something that's a little bit more fit for purpose, which I think is kind of better for humanity as well.
Absolutely.
Yeah,
And it's not just
100%.
downsizers. I know plenty of families that have made the decision to move into the city or the
Yeah.
outskirts of the city in
As
three bedders.
we get more comfortable living around and inside of the CBD,
Yeah.
that's going to continue to happen, isn't it? And although I
Yes.
remember there was a lot of data coming out, there was more people living on their own with the census. And so we thought, well, one bedders could become a popular property type, 10, 15 years ago. But the reality is, and that's only been sped up by COVID, people still want and need that extra space, particularly with the working from home phenomenon.
Very true. Now, there's one more reason why Mark's data has been reflected at the coalface, in my opinion, and that is the taller you go in a building and the more things you have to provide within the building, and the tighter the building regulations get, and the more they change after the building is built, the more expensive the property will be to run. And so we're seeing a lot of very high owners corporation fees, and we're also seeing a lot of buildings that have special levies to counteract some of the issues that have been identified with the cladding, combustible cladding that our state government got really serious about after the London fires and some of the Sydney building issues. So these days, investors are well aware of the fact that even if they're getting amazing rental yields, a lot of it's whittled away with really high owners corporation and special levy costs. So I think there are some key reasons why people have given them a bit of a wide berth, especially the new high-rise ones.
And it's one of those big risks, isn't it? Because something large can just pop up out of the blue, and you have no control over the fact you need to contribute to that cost. So that can scare people off as well. Whereas when it's a standalone dwelling, you can pick and choose to some degree how much and when you spend money on fixing things. So Mike, let's see if we can come back into your wheelhouse. Some of our cities have been oversupplied with high-rise, high-density apartments, and it hasn't necessarily boded well for those investors. Can you share some of the locations around the nation where you have noted these issues? And and this might be our final question for episode number 1 of All Things Apartments before we get into our gold nuggets.
I think it's so big. We've got to turn this into two. Well, we created the rental loss index, which, to be honest, doesn't exist anymore because landlords aren't making rental losses anymore. And I'm looking at the data going, there's no story. So what we actually did is we created a risk rating for every suburb in Australia. There's like 15, 16,000. And we were kind of thinking, well, this would be a useful tool for investors. So I won't go into the nitty gritty of how we put it together, but Victoria normally top the table, and Cate and I unpacked this quite a few times on different podcasts, but places like Caulfield East were always up the top, and I didn't realise why, because I thought, well, that's not CBD, but there's an apartment and a student story there. But places like Carlton, Melbourne, certainly South Melbourne, and then you're getting into places like in and around the Olympic precinct in Sydney. These are areas where we saw such a huge supply of apartments, and we were seeing vacancy rates, certainly in and around the pandemic, get into those double-digit features. So it's not hard to think about it. If you stand in a CBD and you see just a huge amount of apartments, like if you're in south of Sydney, you can see places like Zetland. If you're in Brisbane, there are pockets of towers on the northern side of Brisbane, and in Melbourne, south of the Yarra, pretty much from South Yarra all the way across to South Bank. This is where we saw a huge oversupply. So those are the typical areas.
Yeah. Look, it's a great insight, Mike, and it's not rocket science where the oversupplies are. You pretty much just need to look at the horizon, don't you, and look up.
Yeah.
So, great. Well, look, I think we've covered a lot of gold in this episode number 1 of All Things Apartments, and let's just finish with a couple gold nuggets from you both.
Now it's time for us to go mining for our gold nugget property tip of the day.
In the famous words of Peter Kalezos, I would urge people not to consider an off-the-plan high-rise apartment.
Good one, Cate. Mike, what's yours?
It's hardly a controversial stance, that one, but people still buy them, right? And we've seen people purchasing apartments, nearly half of investments in units, and getting to the point of half of investors purchasing brand new assets as well. So there's certainly data that's supporting people are making investment decisions that I think are quite harmful to them. But I want to sort of make a point that a unit and an apartment these are words that can describe a myriad of different things. People have sort of said to me before, "Oh, Mike, you're anti-new property or you're anti-off the plan." That's not necessarily true, but it's just my brain immediately goes to these high-rise apartment complexes. And I've spoken to a lot of clever people in property, but none of them are confident to be able to put a deposit down on a unit and then 24 months later, when it's settled, make this mozza that's a possibility. So I would caution people to be looking to speculate in those ways. And not all units are bad. There are boutique apartment blocks that will still perform in certain pockets of the country.
Yeah, there are boutique apartments that have views that can't be blocked, that are in amazing locations. There are, aspects of certain types of units that can outperform that are in the medium and high density, but it's a much lower percentage, isn't it?
Yeah, and they can have a quite decent land to asset ratio, which you guys have been talking for a huge amount of time on. That's a really, really important investment fundamental. You can still get a reasonable land to asset ratio with some units, but not when there's going to be 110 in the complex.
No,
and they're brand new.
100%. Yeah. Well, on that note, we might wrap up today's episode. And so thanks both for your contributions. Have a great week, everybody. And we'll see you soon for All Things Apartments Part 2.
See you soon, guys.
See you then.